Don't do this because you read about some guy making millions and millions of dollars and they buy this and they buy that. Do this because you have a passion for the business.
In this episode of Investors and Operators, I am sitting down with David Acharya, who is probably one of the most well-known independent sponsors. I think we have seen you at every possible event that is related to independent sponsors, ACG events, iGlobal, McGuire Woods. You're so well known just because you've been in the industry for so long, and you've also had a recent success with one of the portfolio companies that we're going to talk a lot about. But David, it is awesome to have you here. And just to kind of set the stage for the audience, here are kind of the general topics that we're going to cover today. So first
Sure.
is everything for founders and sellers. What is an independent sponsor? How are they different from funded private equity firms? What are the pros and cons of going with an independent sponsor? And then more specific to you, what's your background in the firm, and why should sellers consider working and partnering with you? And the second audience is independent sponsors. And these are ones who maybe they're in their first year and they haven't done their first deal. You've been in the game for over 10 years as an independent sponsor. So there are a few lessons that we can unpackage here. And then we'll maybe cover a little bit more about family life, fun times, and your upbringing. So that's a little of the background. But before we get into the episode, I want to give a quick background on 51 Labs. So 51 Labs is a digital marketing firm focused on private equity portfolio companies and the M&A industry. We've done over 150 projects with private equity and others in the industry. Based out of Atlanta, Georgia, we do everything from websites to video and LinkedIn content. This Investors and Operators podcast is a media company of 51 Labs. David, let's dive in. Can you give the high level about Acharya Capital, what you focus on, and then let's kind of go into this deal that was a 10-year hold period, but was worth the wait.
Correct. Well, first of all, Jordan, always a pleasure to see you. I think you and I met probably about 5, 6 years ago at DealMax out in Vegas, and love to see both your organization and 51 Vets grow. You've introduced me to David Grenier, who's a great VP on our team, has made a lot of contributions to Acharya Capital Partners. So, Acharya Capital Partners, we are a lower end, middle market focused PE group based here in my hometown, New York City. We invest primarily in three industries: TMT, business marketing services, and light manufacturing. Size wise, about $3 to $20 million of EBITDA. And our investment strategy is basically buy and build. We look for a great platform, a great leader, and then supplement the growth through organic investing, as well as complementary acquisitions, a value creation plan that, quite frankly, was developed over my 30-year career on Wall Street and now at various other private equity firms, and now starting my own firm a little less than a few years ago.
There we go. So, can you talk about what is an independent sponsor, and what do sellers need to know about the difference between your type of private equity firm and a funded private equity firm?
Yeah, so an independent sponsor is basically a private equity investor without having a committed pool of capital up front. How does that differ from working with a private equity firm? When you are a founder and seller and you talk to a private equity firm, the money that they need to invest in your company has already been raised. Versus somebody like me, I raise the money alongside with looking at a company and investing in that company. So, what are some of the pros and cons? I think in today's private equity world, fundraising has become a full-time job. I think there's some challenges with the fund structure model, which is if you have one good deal and one bad deal, the cost averaging averages out, and the team doesn't really make much money. Versus a private, versus an independent sponsor, each deal is a separate fund, so to speak. So you're incentivized to make sure that all the investments pay off really well, and you're also incentivized to make sure that if something goes bad, you need to uh, you need to work on that platform company and turn it around in order for you to walk away with some compensation. So I think if you see the world of independent sponsors today versus where I started, geez, nearly 15 years ago, you're starting to see, I think, much more senior level professionals who work for pretty big firms who started off and uh, uh, and said, you know what, I'm going to go the independent sponsor route. Recently, I was at a really fun dinner among a bunch of founders of private equity groups here in New York City, and I realized, man, that guy worked for a multi-billion-dollar fund. That guy worked for one of the largest private equity groups in the world. And now, here we are, all sitting around trying to do deals. And the one thing we're not really worried about, Jordan, is raising the funds. I think there's so many family offices, what I like to call independent sponsor friendly institutional funds, and a lot of co-invest funds. Just this morning, I had two calls with two co-invest funds, have done independent sponsor deals, and, I've been doing this for a long time, Jordan. I like to think that I know everyone in this business, but it seems like the capital partners who I'm meeting over the last 2 years or so are new to the business and have done some independent sponsor deals and like the independent sponsor investing model versus the fund model. So I actually see this, growing to be even bigger than the funded model structure.
Let's double click on how the fund structure
Mhm.
or how the firm structure benefits sellers. Because if I'm selling 51 labs and I see a firm that has $1 billion fund, like I know they got money and I know they can move fast. So like what why should a seller work with an independent sponsor? Like what's the benefit of that?
So I think the sellers who want capital and want some of the operations expertise, you can get attention from the independent sponsor versus a fund. Last week I was with the CEO that was backed by a PE group, and I said, "How's it going?" And his response was, "I only see them, 3 or 4 times a year, and I do a monthly half-hour call, and I really don't get a lot of support from them." Okay, versus on my portfolio companies, I'm there 24 hours, 7 days a week. I'm incentivized to see you grow. I'm incentivized to make sure that all the resources that you need to grow is there. It's not something I think, when you're one of 15 to 20 portfolio companies, you can get lost in the shuffle. Versus an independent sponsor, each portfolio company is very important, and we'll do everything to roll up our sleeves to make sure that you're successful.
Let's go over to XM Impact. So XM Impact,
Impact XM. Yep. Okay.
Impact
Yeah.
dyslexia coming through at 3:35 p.m. Um, so so Impact XM is a leading experiential marketing agency, and you grew EBITDA 12 times from low single digits.
Mm.
The ROI was a 21 times ROI for investors. So this was a home run. Can, can you kind of walk through the story of Impact XM from, maybe sourcing it
Sure.
to how you grew that business? Because I think that this story is relevant for founders and sellers so they can think about what it's like to work with you.
Mm.
But also, I think it's relevant for other independent sponsors who might be at the beginning of their journey. So let's walk through the Impact XM story.
Yeah, so the earlier part of my career, I was with a funded private equity group, and we did a roll up of B2B trade shows. We bought nearly 70 trade shows across 3 continents. And as part of the diligence, I would always ask exhibitors, what do you hate about these trade shows? And they said, well, we hate the booths because you have to have them, they're expensive. Well, I heard recurring cash flow and high margins. So I started and this actually the thesis to do a roll up in what was then called booth manufacturers, not experiential marketing, actually started, mid 2000s. And it wasn't until I joined my previous firm where I started looking very closely at these companies, and I found there were two types of companies. You had the real large companies on one end that, quite frankly, didn't need private equity money. They were much more established, much more larger companies, and on the other end, you saw entrepreneurs who built a nice little company, $5 to $10 million of revenue. But what it actually it took me a trip to Canada to find the right platform company, and it was a small little company run by a family. It was a father, and all three of his kids were in the business. He's done a terrific job from starting this company and building it to where it was. And I think, it was a classic, I would say, lower middle market story of a family dealing with a generational transfer. The family wanted to take some chips off the table and then partner up with somebody who can take them to the next level. And part of the thesis was shared very similarly with the family, which is there's so many of these companies across America, and it is ripe for consolidation. And they were based in Canada. They wanted to move into the United States, which is the largest, trade show capital of the world. And I was introduced to them by an accounting firm, happened to sit right next to somebody at a networking event, and I was telling him some of the industries that we were looking at, and he goes, "I have something for you." And it was 2013, and we took nearly 12 months to get the deal closed. But when you're dealing with a small company, you want the company to make sure they keep their eye on the ball. But you still have to go through your diligence process. You still have to manage, legal documentation, financing documentation. We had to go raise the money. We worked with a great mezz equity fund called Peninsula Capital of Detroit, and then we also brought a number of family offices to the table. And as I was going through this process, I realized, we had a great leader that we were working with. We had a family that had such a passion for the business, and we saw a lot of opportunity. And it took us nearly 10 years. We looked at numerous add-ons. We did 8 add-ons, and then we probably had to deal with the most challenging time of my professional career, which is COVID. We thought about every risk in the world, Jordan, except the one risk that nobody thought about, which is a global health pandemic, and that nobody could meet face to face. And we were in a business that really focused on face to face. But again, when you invest in good leaders, uh, you, 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 you when you invest in good leaders, you're not just investing in somebody who takes the shots, but can see around the corner. And we were very fortunate with that. And we expanded the business lines quite a bit. It was part of our value creation strategy. We didn't want to be a singularly focused, B2B trade show company. We looked at putting together meetings and events, renting out AV equipment for our clients, doing installation and dismantle, and doing front end creative and strategy work. And as a result of that, we went from being a booth manufacturer to now being a full scale, single source, experiential marketing solutions provider. And the company has grown very well. And after holding this company for nearly 10 years, we decided to, get some value. And, we took it to the marketplace, and we got a lot of, favorable, we got a favorable response. And the company was acquired by Riverside, our common friend Bob Landis, that we all know, a legend in this business. And I still keep in touch with the company, and they're doing very well. So with the part I was really really proud of was not just the fact that we were able to make a lot of money for our investors. But the value creation playbook that I developed over my career, I took various aspects of it, and helped make the company successful. And even when we're not owners of the company, Jordan, it is still successful and continuing to grow. So upon all those, I just great. It's a great success among a number of successes that I've had.
Tell me more about the value creation playbook and how how did you what is the high level breakdown of your value creation playbook just
Yeah.
generally now that's that's probably iterated year after year largely through the impact xm story, but like what is it today? Like what are the key components that you put into action for your value creation playbook that sellers and founders need to
Yeah.
think about? And also, what what do they need to get ready for in working with not just you but any private equity firm of like, hey, if you're thinking about selling in 3 months, 6 months, 12 months, you need to get ready for
Sure.
this.
Okay. So, Jordan, I think every firm throws out the term value creation, and sometimes when I hear it, it kind of makes me roll my eyes, kind of like the word proprietary. But where single-handedly the development of the value creation playbook occurred in the early 2000s when my first private equity job at Apprise Media, both my partners were not former investment bankers, lawyers. They were actually founders of one of the largest media companies in the world at that time called Prime Media. And they did roll ups of magazines, trade shows, online digital products. And it gave me a very different view on investing. Whereas it's coming from the investment banking world, I can do transactions with my eyes closed in the dark. But at that time, private equity was changing from financial engineering to more truly operational creation strategies. And I remember, first few months of the job, I was so proud of the 30-page model that I put together. But the question was asked by my partners, well, how do we achieve this? Okay, and how do we grow the company? It's so easy to put in a cell a particular number, but how do we achieve it? Can we achieve it? How do we achieve savings? It gave me a totally different perspective. And do we have the staff there to help achieve those strategies? So, the playbook isn't what I call, uh, it's not a story. It's not chapters 1 to 10. I hate to use the word playbook. I think what you have to do is assess the situation and then realize what you need to do up front and what you need to do down the line. What I really found with smaller, lower middle market companies, the biggest challenge first is data, getting the books closed, getting monthly data so you can see around the corner versus getting 6 months and yearly data. So I think, the first thing I would tell, if you're a seller looking to talk to guys like me, get your books in order. Okay. Get your general ledger in order. Make sure you can get your AR and AP receivables. Do it on a monthly basis. Even, people like to think of 13-week cash flows as something that is for distressed companies. But I think when you're a small company, doing that 13-week cash flow can give you tremendous insights into your business. So I like to tell, I like to walk, I walk away from a situation. There's three reasons why. One is valuation. Two is this person doesn't really want to work with a private equity firm. They just want to take as much money off the table and stick around for a few years and move on. And then the third is they're just not ready to sell themselves. You ask them, well, can I get the year end or can I get the month end close? And it takes them 4 weeks to turn that around, right? If you ask them for a pipeline report, they start sweating a little bit because it's a manual process. If you ask for the updated AR aging, again, it's a manual process. So I tell all sellers, before you even think about talking to a third party investor, get your books in order, get your processes in order, because the due diligence process can be a huge time suck. And if you're not prepared for it, you feel like you're in the selling the company full time mode and not running the business. As a private equity investor, the first thing I want you to do as a founder and seller is focus on running your business. Because eventually, if we do decide to partner up, I have to make sure that I, invest in a continuing business. So, what I tell all sellers, focus on your processes up front. It'll make the due diligence process a lot more better. It'll also give you some insights to help grow the relationship and figure out what are the risks that we're seeing around the corner. And because we focused a lot on some of these processes, you can determine that risk very quickly up front. Now, as far as the playbook, it's what I think, Jordan. It's multiple chapters, and you need to figure out what to focus on up front and when to focus on it. Okay, so for example,
So let's look at like
sure.
our
So,
example. Like we're a like
yeah,
I meet you and you're like, hey, I've done trade shows, I've done marketing, I get it. I'm like, David, I just like I've been doing
mm,
this for so long, 20 plus years. I want to go to the next level. I think I do have another
mm,
chapter in me with this. Like I just feel stuck. How do I get to the next level? Where do I start? Like, where do you start that conversation with sellers who still want to
yeah,
stay in it? Maybe.
yeah. So, I tell it, usually the first thing we focus on is financial and operating metric reporting. Okay, it is hard to give uh, feedback unless you know what you're giving feedback on. Okay, so for example, development of Salesforce a pipeline report. You sit down with the company, and it's a manual process. So how are you doing as of September 25th today versus September 25th of last year? And it's like, well, we can't necessarily do that because we can't run the reports that way. Okay. So financial and operating metrics reporting is probably usually the first thing that we focus on and enhancing. So, we will make sure that there's a discipline around closing the books on a monthly basis. There's a discipline in getting the data into a computer program so that we can analyze it, and there is a discipline around AR, AP collections, what we owe and what we are supposed to get over the next few weeks. And I think that's usually the first thing I would recommend, sellers and, newly minted independent sponsors and newly minted private equity investors. First, it's hard to give feedback without knowing what you're giving feedback on. I think there's a tendency to say, hey, let's do add ons, right? But if you do an add on and you don't integrate it well, you're now focusing on, instead of growing the business, trying to fix the problems that came with the add on, as well as try to fix the problems that are with the platform company. Jordan, lower middle market companies, the single digit EBITDA companies, they don't have the infrastructure of an Apple or large, global conglomerate. You have people who have multiple jobs within the company, and now you're dealing with a third party, investor. So, when I tell CEOs, how do you pick your partner? Pick a partner that can help you do this stuff versus picking a partner that says, hey, I need this, this, and this done. And they'll say, okay, can you help us out here? Oh, that's what you're here for, right? Versus I think an independent sponsor, they bring a lot of, investing and value creation experience to help you that. And I'm incentivized as an independent sponsor to make sure you grow that way. And if you don't grow that way, it'll be very hard for me to do the next deal. So, there are numerous things that we look at. We look at sales and business development build out, geographic expansion. developing and enhancing new business lines and service offerings, whether they come through us organically, i.e., we build it from scratch, or we look at a complementary acquisition. Over the last 5 years, logical supply chain optimization has played a very big role, and cost and operational improvement. And we look at what I like to call strategic alignment and governance. A lot of these family businesses, they never really did the monthly reviews. They never did board meetings. They never had that conversation. Okay, you know what do we do next year? Okay, what are we focusing on next year? Where
And
it says, hey, we need to clean up all these things that we've done historically. But the board meetings that I like to have, we like to focus a big part of it on what we're going to do next year, and how do we get there, and what resources do you need. Uh, you know, I,
why is that? Because it's interesting. Like our company does not have a board. Like you're talking to the board, and my board is upstairs. But for these companies that don't have a formal board or even an advisory board, like what does that first board
yeah,
meeting look like? And what are some of the aha moments that sellers have, or founders, or the new management teams
yeah.
might
So
have?
I would say early board meetings. It's hard to put this in numbers, but I like to say, 50-50 review historical, 50%, future. And as the investment progresses, we try to look more towards the future. Every board meeting, we review year-to-date financials, review any updates to the year-end forecast, your net working capital, cash balance, and who owes us what, and how much we owe to other people. So AR, AP, aging, and then the pipeline report analysis. Okay. And, usually board meetings, we review financials, review the operational staff, where we need to hire, where we need to, figuratively rearrange the furniture. And part of that is hiring people. Part of that is improving the culture of the firm. Okay. I'll give you an example. At a company, had offices in South Jersey, and I remember the HR person giving us a presentation, and she had one slide dedicated to putting Starbucks coffee machines all around the office and setting up delivery services with local restaurants. And I'm sitting there thinking, now remember, Jordan, I grew up in New York City. Okay, so you can walk 10 feet and run into a restaurant or walk into a deli. But when you're in South Jersey, anything you do, you need to get into a car and drive, maybe for 10, 15 minutes. Versus what we did is as something as simple as that, we were able to keep people, in the office, at their desks, working the phones, talking to clients, and then brainstorming on new ideas. Okay, so for somebody like me, putting up a Starbucks coffee machine in the office, living in New York City, well, every 2 blocks there's a Starbucks that you can walk to, right? But not necessarily, some place like that. So I would say it's not just the analytics, but it's also building a culture. Because ultimately, at the end of the day, the first thing I'm thinking about as soon as we close is eventually we'll have to exit out of these companies. And we cannot sell a bad company in the marketplace. We have to sell something that's a lot bigger. And in order for us to get bigger, we have to get, quality people to work. So we have to supplement the growth of these companies by hiring outside, whether they come in individually or through an add-on. So we're also thinking about how to make this business better, and that's part of the yep, that's part of the value creation
Yeah,
plan.
let's go into that more.
Sure.
Let's go into that more because I'm in a CEO group and talk with other entrepreneurs all the time. And one of the things I was just kind of thinking about in a recent conversation is how can we think exponentially? Because as operators, oftentimes we're bogged down by the day to day and doing a lot of incremental activities. And I think one of the benefits of working with uh, outside investors is that their their job is to exponentially grow the company, to have the exit for their investors, and that it's almost like a forcing function into the business of like, hey, we need to rework how we are approaching overall strategy. That this has to be growing faster. So, what are some of the key levers for transitioning from an incremental growth mindset to an exponential growth
It comes
mindset?
down to culture. I will say, with a single digit, EBITDA company, what is the typical customer base? You typically have one, two, three large customers that were brought in by probably the founder, and then you have a small group, a large group of smaller customers. Okay. Now, how do you grow that? How do you diversify against that? Well, one is bring in additional salespeople. Okay. But then what happens is the existing staff, the CEO is like, well, I don't want my sales force to fall apart. Some of the salespeople that are there are worried about competition. So you really, to make your company a lot more desirable for the next seller, one of the biggest things that hits small and middle market companies is there's a lack of customer diversification. I mean, think about the idea. Jordan, your first client was 100% of your revenue, right? And there's a tendency to focus on
Yeah.
that because guess what? There's some loyalty. They were there first. But as you grow the business, you need to diversify away from that revenue. So you need to go out and find additional customers. And sometimes I think with a lot of small companies, there's a tendency to kind of push back on that. And as a private equity firm, I have to grow this company exponentially. And I cannot rely on those top three customers to grow. So there has to be incentives to diversify away, bring in new salespeople. It's basically the sales and business development build out that I think a lot of small companies are missing out. And the discipline of a private equity investor or an independent sponsor can make sure you keep your eye on the ball on that. So, with all CEOs, they're always thinking about their sales and their customers. I would add another metric, which is the diversification of customers.
Yeah, I think that's really interesting because, like, with our customer base, we have multiple clients. Like, one of our industrial focused private equity firms, like, we do work across seven of their portfolio companies. And, you start at the PE firm, then you do great work for one portco, then it goes across. That is diversification across if you have the relationship with the portco, but then it's also within industrial. So you almost have to like force yourself to do something in a different segment, like, okay, healthcare. So now I have healthcare private equity in the portcos and industrial private equity in their portcos. And it forces you also just to get back there and get new clients
Correct. Correct.
as opposed to just selling within the current client base.
Correct. And with a lot of small companies, I think that forward-looking strategic thinking, I wouldn't say it's lacking. They just don't have the time. I mean, a lot of small founders, they probably spend most of their Fridays working with the CEO to make sure all the revenue gets recognized, all the the P&L gets recognized, all the debits and credits go through. And spending an entire day on something like that is a time suck from helping grow the company. Okay. So leveraging your time, leveraging your skills, I think is a lot harder when you don't have a professional board, an outside investor that can keep that discipline there.
Um, it's kind of making me think that we almost need to have like a advisory board of of
Yeah. Well, if you need one,
give you a
Jordan, let
free
me know.
video.
You
I'll
can,
give you free LinkedIn stuff. But almost as like, and there are people, so many people who will probably want to help out of just like, hey, can I get four people on a Zoom for 1 hour where we run it like a board meeting?
correct.
And it's sometimes it forces us to get out of the day to day SMB mindset into thinking like, well, what would the investor like this, $1 billion fund is never going to invest in us right now, not even close. But I want to maybe he's want to donate an hour to just give us feedback.
Yep.
And I think that we need to do that because it's going to force us to ask bigger questions.
Correct. And it's, with all our portfolio companies in the past, it's always about, okay, how do we grow? How do we grow exponentially? What are the risks that we're seeing and how we can counteract that? And as simple as it sounds, Jordan, it's surprisingly very hard to focus on it when you're always focused on the past. You have limited resources. You don't necessarily have a full-time HR person. Usually, with small companies, the HR person is somebody who won a battlefield promotion of being the office manager, right? And sometimes you talk to the CEO and like, well, who's your HR? Yeah, well, it depends. We have an office manager that writes up the employment contracts and puts up the state labor law posters around the office. I negotiate the healthcare benefits and I negotiate the 401k benefits. Well, no, you really need somebody who is an expert at this, who can not only help handle all this, but when you have a professionally managed HR, your recruiting of quality people and A+ players becomes a lot more easier.
I love it. Maybe shifting gears a little bit, or actually, back staying on the Impact XM story. When you look back, what's the 80/20 of the things that you really, really did right as a team for Impact XM? And then also in 10 years, what are like the most painful moments of like, oh my God, I didn't know how we were going to survive that.
Yep.
And also like, what are some, specific personal challenges that maybe self-inflicted 5 years ago or whenever, like, oh my God, how the hell did I do that? That was insane. But I learned from it and I'm better now 5 years later.
Yeah, I would say, one, we kept the leverage pretty low. We weren't, and when you keep leverage pretty low and you have a slow quarter or a global health pandemic, it's a lot easier to manage versus, you know what, if I miss EBITDA by $20,000, I'm now in default under the bank. So we kept leverage very low. Our CEO was at a point where he was able to do uh, uh, long hires and short fires. Okay. So when we were a much more smaller company, we try to hire as many, people as possible. And if it didn't work out, it took a longer time to separate from them. Versus we're at a point now where we were able to attract much more quality people. And so that was a long hire. And if it didn't work out, Jordan, it was a shorter fire, which, that's a hard thing to achieve with a small company. Because, when you're a single digit EBITDA company and you hire somebody and if it's not working out, there's a tendency to say, you know what, let's give them an extra year. Let's do this. Let's add this. And then, a year later, it's still not working out. It's detrimental to the company. Okay. And then, when you're a small company and you get five salespeople, you try to hire all five of them very quickly. Okay. Well, when you're a much more larger company, Jordan, now you can spend a little bit of time. Are these people culture carriers? Are you going to help us train the next generation of salespeople or the next generation of operations people? Do they have impact, no pun intended, on new customers? Could we get into new verticals that we wanted to get into? We started off as, a generalist company, and then we realized, healthcare a healthcare focused experiential marketing company would make this company a lot more valuable to the next buyer. So we looked at company add-ons and people who had an expertise in healthcare, and it ended up paying off really well. So I would say keep your leverage low. Make sure that you have quality people on the firm, and if they're not working out, you have to make very difficult decisions, which is separate from them. And every CEO on the planet whether you're Apple, Nvidia, or you're the corner family-owned pizzeria. That's the worst part of the job. It's separating from people. Okay, we were very judicious with our cash. We didn't spend willy-nilly on capex, or on anything that we saw as wasteful. Uh, the oh crap moment was, hey, guess what? We're going to shut the whole world down. We don't know when we're going to open up. But having said that, I think, some of the things that we did, which is keep leverage low, keep a high cash balance sheet, and, keep quality people, we were able to come out of this, much more stronger. We had a great relationship with the banks. We had a great relationship with the investors. I remember going back to my family office investors, giving them an update. And I got to tell you, Jordan, that was not the call that anybody wanted to do. And I thought, listen, I was going to be called an idiot. I shouldn't give you any money. Uh, I think the investors respected us enough to say, you know what, this is a one-time blip in our society. We're going to get back to normal. Do you need any more money? No. And so I think those were, some of the things that I think went well. But we didn't contemplate a global health pandemic, but because we did a lot of these conservative actions, I think we were able to come out of this a lot more better. And because we were able to keep the team together, when the business did come back, uh, you know, uh, uh, we went out and hired quality people from the much more larger firms. And, that transition was not something that could easily have happened when you're a small single digit company.
Maybe shifting over to your story growing
Yeah.
up. Like, what is your story?
I'm a New York City boy, born and raised in Queens, New York. I went to St. John's University, started off as a New York investment banker at JPMorgan, spent a few years there.
Rewinding, we skipped over 18 years. Um,
Yeah, so, yeah, so
18 years and 18
yeah,
seconds. But like, what did your parents
sure.
do? You, what sports did you play growing up, or what kind of stuff did you do
Oh,
growing up?
sure. So, both my parents are Indian immigrants. They came here in the late 60s and settled in New York City. And
How'd they come over here?
well, back then, John F. Kennedy and Lyndon Johnson, they had an immigration program really focused on merit. So they needed engineers, they needed doctors, they needed mathematicians. My dad had an engineering background and came to New York City and got an engineering job at the local company and married my mom, and my mom came over and they we
Did they meet in India or meet here?
they met in India. Yeah, they met.
What part of India?
So they're from what's called the Mangalore area, which is a sister city of Bangalore, and it's a coastal town. Think of it as like I would say, Long Island. Okay, and very close to the beaches, but you still had
Yeah.
population density. It was a small little city which eventually grew up to be a tech hub. So the city that I grew up in looks radically different than the city that it currently is now. But they came in the late 60s, and that was the way.
If you Have you been back
I'm
there?
sorry.
Wait, were you
Oh no,
born
I was born
here
and
or
raised here,
there?
but
Oh, okay.
the son of immigrant experience is every few years you go back to the home country of the parents. Okay.
Oh, well, as a father to four half Chinese kids, yeah.
Yes.
It's also like I always have that card I could play. Like, you will not talk back. I will send you to China. Like, I've done it before, and I will do it again. I will accelerate the. I will get a ticket
Yeah.
tonight. And when our 8-year-old was 18 months old, our first business was having trouble, and so Jing and I decided to send her to be with grandparents for 4 months when she was 18 months old. I'm
Oh
like, oh my
wow.
god,
Okay.
that's
Yeah.
this was hard. I'm like, how'd I go from a great investment banking job to this crappy startup life? And then now we live in 450 square
Yep.
feet. And then like first month we were, crying at night. I'm like, oh my God, I can't believe we did this to our
Yep.
18-month-old. And then the second month, I'm like, you know what? This is what life was like before
Yep.
kids. You do this. Okay, she's still there a couple more
Yeah,
months.
both
um,
my parents, they worked, and they had side gigs before the term side gigs or side hustles were created. My dad sold desktop computers to small businesses around Queens, and my mother was an importer of costume jewelry from Italy and Taiwan and parts of Eastern Europe. And that was a really unique experience because when you grow up in New York, Jordan, you have a lot of exposure to multicultural other cultures. But when we do business with them, it gave me a huge advantage. And a lot of the skills that I learned came in handy when I started going to, investment banking kickoff meetings and M&A negotiations and, working with the sales force and selling, high yield bonds or an IPO. And so, my parents did the side hustles all throughout, my career, well, all throughout my life. And I, grew up, partly as, a son of Indian immigrants, and I grew up as American. I played Little League. I played, PV football. These are two sports that, my parents probably didn't understand when they were coming here and they had to learn it because they had to see me watch this. But there was also an emphasis on education. And I was very fortunate to like be focused on that because it's a hard thing to do, particularly when you're growing up in middle class and Queens and working class Queens. Everybody wants you to get a job as soon as you're getting out of high school. My parents were like, you're getting a college degree, you're focusing on that. And I ended up getting 2 degrees, both a bachelor's.
you didn't let down the Indian parents too much by 2 degrees. Like, I'm not going into med school, but I got two
Exactly.
degrees. Does that work, guys?
Exactly, exactly. And we had
Did they want you to go to a particular education or particular
no,
career field?
I know stereotypically they try to push every kid to medical school or PhD school. My parents, they kind of, the way they guided me is don't worry about the past, worry about the future because technology was changing. I had a home computer at home in 1983, which was unheard of, with a lot of families. But it gave me a skill set that when I got into high school and college, I wasn't playing catch up with a lot of people.
Yeah.
I was
Yeah.
using a word processor in the fourth grade. I was using what was called Lotus 123, which is the predecessor to what is now Excel. There was no Excel, there was no Word in the 80s. It was Lotus 123 and another company called Word Perfect. Not even sure both those companies exist anymore.
Is that your investment banking interview answer? Like, I've been doing this since I
Yeah.
was 10 years old. I made it to
Yeah,
this.
it was I love growing up in Queens. I actually still live here. I'm 4 blocks, so I'm 4 subway stops from Midtown. I'm 15 minutes from the airport, which is great for somebody in my line of business. And where the neighborhood has gentrified over the last 25 to 30 years. So I have neighbors who are deal lawyers and deal accountants. Running into them at a Starbucks can be a middle market focused networking event, especially on a Saturday morning.
That's awesome. What are like a couple of lessons that you got from each of your parents that either was, conscious and overt and like, all right, I'm finally doing it, or that you've realized like, decades later, oh my God, I just never knew that I was learning this from them.
Yeah, I would say from my dad, get a strong technical skill set. Okay. Because if you understand the technicals, you understand whether you're doing the right thing or somebody's trying to BS you. Okay. So for example, as of now, I have, a wealth manager, proposing an investment. Okay. And I look at the returns, compare it against treasuries, call them out on it. I think that focus on technical skills was really has come in handy, particularly in finance, particularly in private equity. Okay, for my mom, she's a daughter of a politician. So yeah, so between my grandfather and my mom, they taught me how to connect with people, how to shake hands, how to walk into a crowd and start up a conversation. And, when you are deal sourcing, that's a skill set you need. You can't be an introvert. When you are in a room full of, 15, 20 investment bankers, and you need to pitch your idea, you need to be very comfortable with that. So I think, the combination of the qualitative skills that my mother brought and then the quantitative skills that my dad taught me, I think made me a much more fuller and rounder person than a lot of uh, my friends growing up. So it really put me at a huge advantage at college and job searches, and now in my running my own private equity firm. If I was an introvert, you couldn't find deal flow, right? You couldn't find, if I was an introvert, you wouldn't see me at all these events trying to shake as many people's hands and trying to find that next company that we want to invest in. So I took some great skills from both of them, and very fortunate to be in that position.
That's awesome. Um, are there any particular books that have really kind of been something you always reference throughout your career, or any particular guiding quotes or thoughts that have just kind of been always in the forefront of your mind? So for example, like I have a yearly journal and I've been keeping
Yeah,
it for 10 years. And like there's one quote I just keep on coming back to. I just keep on coming back. I'm like, okay, I finally get it.
yeah.
Um,
My first private equity boss was an operations focused investor. Didn't grow up on Wall Street. He had legal training, but he did more corporate development than working for a big law firm. And one of the things he taught me in due diligence is trust, but always verify. Okay. And there's a tendency when somebody tells you something, you tend to take their word at it. And I think in certain industries that's okay, but when you're an investor, it's not. Okay. So I think, trust but verify. So when I get due diligence, materials, I always try to come at it from a different perspective and see whether I get that same conclusion. Okay. And the investments where uh, I didn't get the same conclusion, I walked away from it. And they always say the best deal is the one that you never did. In those situations that I walked away from it, I avoided a big headache and a big loss. And then in situations where I looked at it from a totally different perspective, but came up with this same conclusion, it worked out because one, I was dealing with an honest person who knew how to solve business problems, and that is something that you want to back, Jordan. Okay, and so trust but verify. I always come back to that. And over the last 20 years or so that I've learned from my first boss, Michael, I always come back to that, and it's always served me very well. Uh, you know, Also the other, thing I've learned from my parents, which is, do the right thing. Okay. And it's not doing it when social media is watching you, but doing it when social media is not watching you. And, it's, even things like separating from people. Okay. There's a way to handle it where, I'll give you a perfect example. I had a friend who I met at one of these networking events, and unfortunately, I had to separate her friend from from a portfolio company from many years ago. And she said to me, "Hey, listen, I want to work for you." I'm like, "Well, why do you want to work for me?" And like, well, I saw the way you handled the layoffs during a really difficult time. And the fact that all the people that you laid off during that time period, and I knew all of them, all told me it was a difficult time period. But if David called me up to rehire me, I'd take the job once again. Okay. Because I didn't really think about it. There was no promotion around it. There was no social media at that time. You try to do it as humanely as possible, including the fact that I helped find jobs for some of these people that I had to lay off during this really difficult time period. So, the other thing is, I always try to do the right thing. Okay. And, we never really bend, don't bend the law, do the right thing, because ultimately, at the end of the day, the customers who are your source of revenue are going to respect that. And they're going to come back to you over and over again. And I've seen that with my investors. I've seen that with funds who I've worked with. I've seen that with former colleagues, and also, with my competitors who, literally sit on the other side of the table, will say, "Hey, David, we should take a look at doing a deal together." Okay, so again, it's trust but verify, and always try to do the right thing. In terms of books, I read this really interesting book, and I want to get the title right, because I always call it one particular. Uh, uh, but this was actually uh, uh, recommended to me by a very senior investment banker during my investment banking days. And it's called Memories of Extraordinarily Popular Delusions and the Maddening of Crowds. Okay. And it was,
I love the title already.
yeah, it was written in the mid 1800s by Charles Mackay. Okay. And it really taught you about, uh, like I always thought, why does the stock price go up? Because you have, increasing dividends, you have a lowering cost of capital. So you put in the formula, the stock price goes up. And then I saw the boom market of the 90s and realized the stock price goes up because there are more buyers than sellers. Okay. And then when you have this maddening rush, you have asset prices go up. And then, as somebody who's part of this, ecosystem, you want to go out and be part of the excitement too. Okay. And what this book did is talk about uh, various parts in history where the maddening of crowds, you know, uh, 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 demolished a particular market. So, for example, there was something called the tulip mania in the mid 1600s, okay, where people would buy tulips in a market in Amsterdam. And because there was a shortage, people kind of ran in, but there was bad information. So when that good information came in, the market crashed, and all these tulip growers went bust. Okay, now this is something that's reminiscent of various market crashes over the last few years. Okay, and I remember when I first read that book, I read it again, and I read it again around 2007. Okay, and I remember I was at that time there was some remnants about mortgages, but it wasn't on, the tip of everybody's tongue. And I remember going into a meeting with my bosses, and there was an investment banking team, and then there was the head of credit for this particular bank. And I'm like, well, that's strange. I've been to hundreds of meetings with investment bankers, and the only time the head of credit shows up is because they're really concerned about something in the future, and they have some questions that they want to ask. And I remember, this investment banking team was pitching us uh, a debt structure that, quite frankly, was pretty aggressive. Okay. But the questions that the head of credit was asking, it got me really concerned after the meeting was over. I remember I told my bosses at that time I was a mid-level guy. So, I had experience, but not a lot of experience. I said, so what do you think about the meeting? I'm like, oh, like any other investment banking team, they're proposing something for us to buy or sell. I get it. But man, the last time I saw a credit head of credit come to a meeting was early 2001, just before the dot-com crash. Hey, yeah. So I saw this and I said, "Man, this is pretty bad." And I remember calling my broker, getting out of some of the more speculative stocks. My broker said, "David, you're making a mistake." And then, the whole banking industry fell down. So, again, it's a lesson from the maddening of crowds when you see just a bunch of people come into a marketplace. Uh, Jordan, you should read this book. It is about 200 years old, the book, but the lessons there, I still go back to it. And I still, review it just to make sure that's still embedded in my mind. Now,
Oh,
growing up in New York City in the '80s, I read all the books, Liar's Poker, Predator's Ball, and there were good books to read at that time, but they went back on the shelf. But this is one book. When I have a little bit of time, when I'm really thinking about the future, I'll read it. And uh,
there we
yeah,
go.
yep. So that's a book that really has given me a lot of lessons.
All righty. Um, so if maybe to kind of close this out and going back to
Yep.
independent sponsors, if you had to kind of summarize the top two or three piece of advice for new independent sponsors, what would you advise them on?
Make sure you have runway space. Okay. You're not going to do your first deal 3 months when you start. I think it's basically 2 years or so before you can do that. The second is take care of yourself. Okay. There's a tendency when you're an entrepreneur, you let your health suffer a little bit, your nutrition goes down, you don't exercise, you're in the office, 24 hours, 7 days a week. Go out there, connect with your family, connect with your friends, do something very different. And the third thing is don't give up. If you have a passion for investing, you have a passion for transactions, being an independent sponsor can be great. When I started, there was no boot camp class. There was very few independent sponsor conferences. And when there was like five of us together, including mentors like Doug Song and Richard Bound and Bruce Lippian. They were my boot camp class when I started 15 years ago because they started a lot more earlier. But there's a lot of resources out there to keep you informed. There are a lot of events, so I suggest going out to an iGlobal forum, the Independent Sponsor Forum. I think both of them have done great jobs to really focus on the independent sponsor world. There's the McGuire Woods event down in Dallas, and from what I can tell, it'll continue to grow and it'll continue to grow. So I just tell people, first timers, make sure you have runway space. Okay, particularly when you have kids and you're married, because that conversation of, hey, things may work out 5 years from now, I'm not sure. Okay, but this could be a pretty interesting thing. And sometimes if you don't have that runway space, you won't be able to, to do what you want to do. And then two is, you have to have passion. Okay. Don't do this because you read about some guy making millions and millions of dollars and they buy this and they buy that. Do this because you have a passion for the business, you have a passion to bring capital, you have a passion to grow. Because once you have that passion, those other external factors come into the compensation, the desire to continue to grow and do well. To me, and I saw this in the '90s. Why did a lot of people come into investment banking? Because they thought they could make seven figures in 2 years, and they realized, well, it doesn't really work that way, and they're really unhappy. I got into the business because I had a passion for transactions. I had a passion for growing businesses. I had a passion for the excitement of the markets. Yes, compensation was great, and I did very well. But you have to have that passion. And then the third thing is, there's a lot of there's so many resources out there. Get to know them. Get to reach out to them. Go to events. Read up on a lot of things. And if you do all those three things, I think you're on the path of success. Okay, and that's what I would tell for new independent sponsors, because those three areas that I've told you was the three areas that I wish I focused on when I was kind of growing up in the business. I became an independent sponsor because the fund I was working for was not able to raise fund two because Bear Stearns just failed, and every time you called a friend for a job, it's like, hey, listen, I'm not even sure this company is going to be here in a few months. Luckily, a former colleague of mine called me and said, hey, I started this fundless sponsor group. I mean, the term independent sponsor didn't even wasn't even circulating. It's fundless sponsor, and I said to him, man, if you can give me two words in finance that are an oxymoron, it's fundless or sponsor. But within 12 months of joining them, I closed my first deal, and I compared and contrast of being an independent sponsor versus being a fund, and I realized capital's there if we have a good deal, but you really should focus on finding a good deal, and people who manage small funds are telling me, David, it's a big mistake. Because I'm spending half my time on fundraising and making sure that document gets filled out and that document gets filled out versus fundraising now is really reaching out to existing network and creating a new network, and all the documentation is all related to the deal itself. So as I tell people, if you can have those three things, I think being an independent sponsor can be a great career path for you.
Yep. That's I think the coolest thing about it is just the maturity of this sub asset class.
Correct.
And it's you see people not choosing not to go down the funded route or leave the funded route because of how robust and mature and sophisticated the independent sponsor community is, from not just the independent sponsors but also the capital providers, and then the the breadth of the service providers that now are spending a ton of time with the independent sponsors. So, super interesting time. And I'm really glad that we had a chance to dive into your story, the firm story, and then also with ImpactXM and growing that. I mean, it's a super cool story. And if people are interested in reaching out, what's the best way to get in contact with
Uh, Email Acharya at acp-co.com. It's on the website, www.acp-co.com. And I'd love to hear from companies that are looking to partner up with a private equity firm and really think about growing their businesses and taking them to the next level. But Jordan, always a pleasure to talk to you. Appreciate the opportunity. Great work with 51 Vets, and I know from personal experience the quality of people that you've attracted, including David Grenier, who's a VP on my team, has done a terrific job. And looking forward to seeing you in New York City very soon, or maybe at another conference somewhere in the country. And my God, your kids are just getting more and more beautiful as each day goes by. So, congrats to
well,
both you and your wife.
thanks. All right. Thanks so much for doing this.
Thank you. Have a good day.
See ya.